Preparing for a finance manager at REWE interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a finance manager at REWE? REWE appeals to me because finance is closely connected to everyday operating decisions, from pricing and promotions to store productivity and supply chain efficiency. I would value working in a customer-focused business with significant scale and a cooperative heritage. My experience in forecasting, performance analysis, and stakeholder management would help managers turn financial information into practical actions. I am particularly motivated by roles where finance improves both profitability and long-term resilience, rather than simply reporting historical results. While answering, connect your motivation to REWE's retail scale, cooperative roots, customer focus, operational complexity, and opportunity to influence decisions through commercial finance, disciplined performance management, and strong cross-functional partnership. Question 2. How would you assess the financial performance of a REWE supermarket? I would begin with like-for-like sales, separating customer traffic from average basket value. Then I would analyze gross margin by category, promotional effectiveness, shrinkage, labor costs, occupancy, utilities, and other controllable expenses. I would compare actual performance with budget, prior year, and an appropriate store peer group. Finally, I would examine cash conversion and operational drivers, because a store can report acceptable profit while carrying excess inventory or suffering weak execution that threatens future performance. Make sure to cover sales growth, like-for-like performance, gross margin, labor productivity, shrinkage, occupancy, operating expenses, EBITDA, cash conversion, customer traffic, basket size, and comparisons against budget and relevant peer stores. Question 3. Which KPIs would you monitor most closely in food retail? My core dashboard would include like-for-like sales, customer traffic, average basket, gross margin, waste, shrinkage, on-shelf availability, inventory turns, labor cost percentage, and EBITDA. I would also monitor working capital days and cash conversion. The important point is linking metrics. Strong sales growth is less valuable if promotions destroy margin or inventory creates waste. I would use exception reporting to focus management attention on unusual movements, then investigate the operational cause rather than treating KPIs as isolated accounting outputs. In your answer, talk about revenue, comparable sales, traffic, basket size, gross margin, waste, availability, stock turns, labor cost ratios, shrinkage, EBITDA, working capital, and how each KPI supports a management decision. Question 4. How would you prepare a monthly management report for REWE leadership? I would start by validating the close data and reconciling major movements to the general ledger and operational sources. The report would show actuals, budget, forecast, and prior year comparisons, followed by a short explanation of material variances. I would distinguish volume, price, mix, timing, and one-off effects, then identify owners and corrective actions. For executives, I would keep the presentation focused on decisions, risks, and outlook, supported by detailed analysis available for follow-up questions. Be sure to mention data validation, concise executive messaging, actual versus budget analysis, root causes, risks, actions, KPI trends, materiality, stakeholder review, and tailoring the report to decisions rather than merely presenting financial data. Question 5. Tell me about a time you explained a complex financial issue to a non-finance stakeholder. In a previous role, a purchasing manager questioned why a profitable-looking promotion reduced forecast profit. I translated the analysis into 3 drivers: discount depth, supplier funding, and product mix. Using a simple bridge, I showed that volume increased 12%, but contribution fell because funding covered only part of the discount. We redesigned the promotion and improved the supplier contribution requirement. The experience reinforced that finance creates influence by making commercial consequences understandable and actionable. While answering, use a clear star structure. Explain the stakeholder's business concern. Simplify technical language. Quantify the impact. Show how you influenced action. And describe the measurable result or lesson learned. Question 6. How would you investigate a significant variance in gross margin? I would first confirm that the variance is genuine by checking postings, master data, cutoff, and margin calculations. I would then split the movement into purchase price, selling price, mix, promotions, supplier rebates, markdowns, waste, and shrinkage. At REWE, category and store-level analysis would help identify whether the issue is broad or concentrated. I would discuss findings with purchasing and operations, agree corrective actions, and update the forecast if the underlying economics had permanently changed. Make sure to cover data integrity, purchase costs, selling prices, product mix, promotions, supplier rebates, markdowns, waste, shrinkage, timing, accounting treatment, and collaboration with buying, stores, and supply chain teams. Question 7. How would you build a budget for a supermarket or retail division? I would build the budget from operational drivers rather than simply applying a percentage to last year. Sales would reflect traffic, basket size, pricing, category mix, store changes, and promotional plans. Costs would incorporate labor hours, wage inflation, rent, utilities, logistics, shrinkage, and planned investments. I would create base, upside, and downside scenarios, challenge assumptions with commercial leaders, and document clear ownership. The final budget should be ambitious but operationally credible and linked to strategic priorities. In your answer, discuss driver-based planning, store openings and closures, volume, price, mix, promotions, labor, rent, utilities, capital expenditure, inflation, scenario analysis, ownership, challenge sessions, and alignment with strategy. Question 8. What is your approach to forecasting in a volatile retail environment? I prefer a rolling, driver-based forecast updated with the latest trading evidence. I would monitor traffic, basket size, price inflation, category mix, supplier costs, promotions, labor availability, and energy expenses. Rather than producing one falsely precise number, I would present a base case with downside and upside sensitivities. I would compare prior forecasts with actual outcomes to identify bias, especially optimism around sales or underestimation of costs, and communicate changes early so management can respond. Be sure to mention rolling forecasts, key business drivers, current trading data, seasonality, inflation, promotional calendars, supplier conditions, scenarios, forecast bias, sensitivity analysis, and frequent communication with operational stakeholders. Question 9. How would you improve working capital at REWE? I would focus first on inventory, because food retail requires availability but also faces perishability and waste. I would analyze stock turns, aging, forecast accuracy, order quantities, supplier lead times, and markdowns by category. I would also review payment terms and timing of supplier funding, while protecting relationships and contractual compliance. The objective is not simply to reduce inventory, it is to improve cash conversion without increasing stockouts, lost sales, waste, or operational disruption. Focus on inventory availability and turns, supplier payment terms, receivables, waste, forecasting accuracy, replenishment, promotional planning, cash conversion, service levels, and avoiding improvements that damage customer experience or supplier relationships. Question 10. How would you evaluate a proposed new REWE store investment? I would build an incremental cash flow model covering sales ramp-up, gross margin, cannibalization, labor, rent, utilities, logistics, maintenance capital expenditure, taxes, and working capital. I would evaluate NPV, IRR, payback, and cash break-even, but also test sensitivities for traffic, basket size, margin, opening delays, and construction costs. Strategic factors such as local market presence may matter, yet assumptions must remain transparent. After approval, I would compare actual performance with the investment case and explain variances. In your answer, cover incremental sales, cannibalization, margin, labor, rent, logistics, capital expenditure, working capital, ramp-up, tax, NPV, IRR, payback, sensitivities, strategic benefits, and post-investment review. Question 11. How would you assess the profitability of a promotion? I would compare promoted sales with a realistic baseline, not assume every unit sold is incremental. The analysis would include discount cost, product margin, supplier funding, cannibalization of higher margin items, additional labor, waste, and any post-promotion demand effect. I would calculate incremental contribution profit and assess customer traffic or retention benefits separately. If the promotion increased volume but reduced contribution, I would recommend changing price depth, timing, product selection, or supplier funding rather than repeating it unchanged. While answering, include incremental volume, baseline sales, discount cost, gross margin, supplier funding, cannibalization, waste, customer response, post-promotion effects, contribution profit, and whether the promotion supports broader commercial objectives. Question 12. What controls would you consider important in a large retail finance function? I would prioritize controls over cash, inventory, purchasing, supplier rebates, payroll, master data, and financial close. Key mechanisms include segregation of duties, approval limits, independent reconciliations, controlled journal entries, physical inventory procedures, system access reviews, and exception monitoring. Controls should be practical for stores and supported by clear ownership and evidence. I would assess whether they operate consistently, not just whether they exist on paper, and use risk-based testing to focus effort where financial or fraud exposure is greatest. Mention segregation of duties, authorization limits, reconciliations, master data governance, journal controls, inventory counts, cash controls, access management, exception reporting, evidence retention, fraud prevention, and risk-based testing. Question 13. How would you manage the month-end close under tight deadlines? I would establish a detailed close calendar with clear owners, dependencies, deadlines, and escalation points. High-risk areas such as inventory, supplier rebates, payroll, accruals, and cutoff would receive early attention. I would use materiality thresholds and standardized reconciliations to focus review effort, while automating recurring checks where possible. If an estimate were necessary, I would document the basis and true it up later. Speed matters, but management decisions require numbers that are controlled, explainable, and consistent. Be sure to mention a close timetable, ownership, materiality thresholds, reconciliations, accruals, cutoff, automation, issue escalation, review controls, documentation, and balancing speed with reliable financial information. Question 14. How would you handle a disagreement with a store or commercial director over financial results? I would first understand the director's operational perspective and clarify exactly which assumption or result they dispute. Then I would walk through the data source, calculation, and bridge, separating factual differences from judgmental assumptions. If both views were plausible, I would model the alternatives and agree what evidence would resolve the issue. My goal would be a shared action plan, not winning an argument. I would escalate only when material risk remained unresolved, with facts and options clearly documented. In your answer, emphasize listening, fact-based analysis, shared objectives, transparent assumptions, operational context, respectful challenge, alternative scenarios, agreed actions, and escalation only after constructive resolution attempts. Question 15. What is the difference between gross margin and contribution margin in retail? Gross margin is sales less the direct cost of merchandise, usually expressed as a percentage of sales. Contribution margin goes further by deducting variable costs associated with selling the product, such as transaction, delivery, or incremental handling costs. For a promotion, gross margin may look acceptable while contribution is unattractive after additional activity costs. I would use gross margin for category performance and contribution analysis for incremental decisions, while keeping fixed store costs separate when assessing operating profitability. Make sure to define both measures, explain included costs, show their usefulness for pricing and promotions, distinguish fixed from variable costs, and connect the analysis to store, category, and decision-level profitability. Question 16. How would you deal with inventory shrinkage and food waste from a finance perspective? I would quantify shrinkage and waste by store, category, product type, and cause, then compare results with operational benchmarks. I would test receiving, counting, storage, expiry rotation, markdown, and disposal processes, while distinguishing accounting errors from genuine losses. Finance should help prioritize interventions, such as improved ordering or earlier markdowns, and track benefits against implementation costs. Targets must be realistic. Cutting waste too aggressively can create stockouts, damage availability, and reduce customer satisfaction. Focus on quantification, root cause analysis, category and store comparisons, cycle counts, receiving controls, expiry management, markdowns, process ownership, realistic targets, and balancing loss reduction with availability and customer service. Question 17. What accounting and reporting issues would you consider in a REWE finance role? I would pay close attention to inventory valuation, supplier rebates, promotional arrangements, provisions, leases, revenue cutoff, impairment indicators, and consolidation across the relevant entities. The applicable reporting framework, whether international financial reporting standards or local statutory generally accepted accounting principles, determines recognition and disclosure, so I would follow group policies and document judgments carefully. Retail contracts can be complex, especially when funding or rebates depend on performance. I would involve technical accounting and auditors early when a transaction could materially affect reported results. Mention international financial reporting standards or applicable local generally accepted accounting principles, consolidation, leases, provisions, inventory valuation, revenue recognition, supplier arrangements, impairment, cutoff, disclosures, and the importance of consistent policies across entities and formats. Question 18. How would you use data and automation to improve finance at REWE? I would begin with a repetitive, high-volume process such as reconciliations, variance reporting, or store data consolidation. After confirming source data quality and control requirements, I would automate standard steps and build dashboards that highlight exceptions rather than reproduce every transaction. Finance professionals could then spend more time explaining drivers and supporting decisions. I would measure success through reduced close time, fewer manual errors, and faster issue resolution. Automation should strengthen controls and usability, not create an opaque process. In your answer, discuss data quality, ERP integration, automated reconciliations, dashboards, exception-based reporting, forecast models, process controls, user adoption, cybersecurity, and measuring time savings or decision quality. Question 19. How would you support sustainability decisions while maintaining financial discipline? I would incorporate sustainability into the same rigorous investment framework used for other decisions. For example, an energy efficiency project should include capital cost, maintenance, expected utility savings, carbon reduction, incentives, asset life, NPV, and sensitivity to energy prices. Food waste reduction may also improve margin and customer trust, but benefits need reliable measurement. I would report both financial and environmental outcomes, with clear assumptions, so leaders can compare initiatives consistently and avoid relying on unverified sustainability claims. Be sure to cover energy, refrigeration, logistics, packaging, food waste, capital investment, operating savings, carbon impact, payback, NPV, incentives, measurement, and avoiding unsupported claims or short-term only evaluation. Question 20. What would your priorities be during your first 90 days as finance manager at REWE? During the first month, I would learn the business model, reporting calendar, systems, key stakeholders, store economics, and current strategic priorities. In the second month, I would validate major KPIs, close processes, forecasts, controls, and recurring pain points by speaking with finance and operational teams. By the third month, I would propose a focused roadmap, protect reporting quality, deliver 1 or 2 practical quick wins, and define longer-term improvements with owners, milestones, and measurable benefits. While answering, outline listening and stakeholder mapping, understanding strategy and reporting, validating data and controls, identifying quick wins, learning store operations, building trust, and establishing a prioritized improvement roadmap. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.